So Lynn, you came out with your article on Ethereum, and it had a lot of readership. I think you laid out some amazing things in there that would take we could cover that for an hour and a half. In fact, I reached out to Vitalik to come on and have the discussion. We didn't hear anything back from him, and maybe we need to just do a whole episode on your Ethereum article. I'll have it in the show notes for people to look at and read because it is amazing. But with all that said, when we look at the price action of Ethereum compared to Bitcoin over the last, I'd say 2 months, it has aggressively outperformed Bitcoin. What do you think's going on? And do you see a situation where, even though you're making all these fundamental arguments, which I completely agree with, do you see this having the capacity to achieve a higher market cap in the coming, 6 months or year moving forward? I'm kind of curious to hear if any of your analysis have changed based on how the market's valuing it, and just some of your thoughts.
Yeah, that's a really good set of questions. And so, for people that aren't aware of it, I basically analyzed Ethereum. It was somewhat of a critical analysis, so it wasn't super favorable towards Ethereum. There's a couple points where I try to be fair as possible, right? So if it's doing something interesting, I say, okay, this part's interesting, but kind of the net overall case was rather critical and why I prefer Bitcoin as an investment, and it really comes down to decentralization. That I ultimately view Ethereum more like an equity where you're in a sense, people that are buying into it are betting on the development team being able to push out updates and structure how they want to basically make this system that they envision, rather than a decentralized, digitally native form of money, which is what Bitcoin is. And historically, whenever we have these alt seasons happen, generally there's one big alt season per Bitcoin halving cycle, and you start to get this inverse relationship between quality and price action, where literally the worst coins do the best coins do the worst. And so the funny thing is, you can characterize this Ethereum bull run as, though it's basically, some people are saying, does that mean it's fundamentally improving? And it's one of those things where even though Ethereum outperformed Bitcoin, if you go down the quality spectrum, you have even smaller coins outperforming Ethereum, right? So the fact that Ethereum Classic outperformed Ethereum year to date, does that mean that Ethereum Classic's network effect is gaining on Ethereum's network effect? I would say probably not, right? I mean, for anyone that knows technical details, the network effect is on Ethereum, not Ethereum Classic. And same thing with, you have Dogecoin, right? So does Dogecoin, it certainly had a surge in popularity, but for anyone who knows kind of people that have shared their experiences running a full node for Dogecoin, or how that actual network functions, or what kind of development, crickets have taken place over the past couple of years, basically what we've had is kind of an inverse correlation between price action and quality year to date, and that's happened in previous bull markets. And it's one of those things where after I wrote my Ethereum article, I even wrote in the article that I wouldn't be surprised to see it outperform Bitcoin on the bull leg of the market. I'd be more concerned about how it does along with other altcoins on the bear market portion of the cycle. And because I have a research service, I cover Bitcoin frequently, but I've occasionally touched on Ethereum for a broader picture. And I keep reiterating, for a while now, that I was like, okay, if it breaks over this level, that's very bullish for the price action. And I would, a couple weeks later, I'd give another update and say, yep, it still looks, bullish for the price action. And I kept reiterating why, personally, I think Bitcoin is the more structurally sound protocol, but that you can separate, fundamentals from price action and say, for people that follow Ethereum, here's what the price action looks like. It's bullish, but just if you want to go that route, be really careful, because there's, I kept reiterating that I have concerns about decentralization and kind of the underlying use case, or the kind of the reason for existence of the protocol compared to Bitcoin, which I view as a more sound investment.
Preston, can I build onto that? Because
Yeah.
I think there's an important part. So today, a network effect is when the value to each user gets stronger and stronger from a network effect. There are a lot of people in the late 90s, early 2000s that mistook network effects for eyeballs. So they were buying more eyeballs. thinking it was a network effect and that growth would always be there. But if it's not making the network better for all users, then the network effect doesn't exist. So now let's look at a time period and say Lightning wasn't there 5 years ago, and Ethereum was there. And so Ethereum kind of, and then the whole NFT craze came on. So there is actually as value, and people think there's value on Ethereum because NFT is driving as a whole bunch of more people on it. So let's examine that for what it is. I totally agree with Lynn, by the way, on it could outperform in the short term, but not in the long term. And this is it now. Let's look at the NFTs, which is driving a whole bunch of the rate of growth on Ethereum. I look at the NFT market like I would look at Groupon from a business. Remember Groupon?
Mm-hmm.
So Groupon created an incredible business by getting everybody to buy the one thing, right? And so they had one great deal that everybody bought. But the only way to scale that business was to add more things. And as they scaled, it just became noise, more and more noise. And then nobody cared about the one thing anymore because it was noise. And then there was so many other competitors that did the exact same thing. When I look at NFTs on top of the primary source of value in the growth rate today of Ethereum, that's what I look. So I discount that growth because it's not a stable business over time. And so today there's a whole bunch of people thinking, wow, that's going to be this staggering business. And I think they're overvaluing it like they overvalued Groupon that then fell to the floor. And apart from that, and this is where Druckenmiller and agree, that technology might just be built onto Lightning Network, on the base port protocol, or something else kind of based on it didn't exist before, but now it's starting to emerge. And so what's being built on top of Bitcoin on the network is just in its infancy. And we're going to see a whole realm of things tied into the base protocol.
Yeah, one thing I was going to say is the example of stable coins, and that's something I've covered a little bit in my Ethereum article and elsewhere, which is that some of the earlier stable coins were tied to the Bitcoin network, and then when you had Ethereum, you started to have them move over to Ethereum, right, because it was cheaper and kind of made for that sort of thing, and then now as Ethereum's gotten more expensive, you've had stablecoin usage spill over onto Tron, of all things. And so, the problem with utility protocols is that when you start sacrificing, certain variables, basically you're making things more efficient in exchange for centralization. Then another protocol can come around and make things even more efficient, but with more centralization,
right,
where basically until it just approximates a database. And so that's what we're seeing in the stablecoin space, where it started out with smaller transactions. They have a more incentive to move to a cheaper chain, because if you're doing $100 transaction, you can't pay $50 for a transaction. But if you're doing a $10,000 transaction, then you can, right? So smaller, but as the fees get higher and higher, a bigger chunk of the usage spills over onto that other protocol. And the same thing's happening, with Binance. It's another kind of decently sized network effect that's kind of coming into that space. And this was outlined in John Pfeffer's paper several years ago, where utility protocols essentially have to compete on price. And so the network effects are not going to be as strong there as they will be for something like Bitcoin. And I've spoken with John before, and he's certainly he's paying pretty close attention to this industry. I think he has really, really good points on that. And I generally agree with that paper, where even if you do get some degree of network effect in the utility protocol space, which, for example, Ethereum has for a number of years, that doesn't necessarily translate into long-term token appreciation, because your reason for existing is going to be constantly threatened by cheaper, more centralized competitors. And whereas Bitcoin doesn't really have that problem, because the entire point is to just be a decentralized store of value, and then you can build other things on top of it to make it a better and better payment network and a smart contract network and whatever the case may be if people want to add those features. So for example, the Lightning Network is obviously a really good use case there that basically strengthens Bitcoin, but that the underlying protocol has a lot more defenses against competitors compared to those utility protocols.
In your article, you were talking about Infura with your Ethereum article. And on the website for Infura, this was the quote that you put in the article. It said, "It can get expensive to store the full ETH blockchain, and these costs will scale as you add more nodes to expand your infrastructure. As your infrastructure becomes more complex, you may need full-time site reliability engineers and DevOps teams to help you maintain it." And that's today. Right? Like those statements are being made today, and that's why they're saying that a person should outsource that to them to manage. And I'm just thinking to myself, like, how is that something that in the long term is going to remain decentralized? And yeah, go ahead, Lynn.
Well, especially as you move over to Ethereum 2.0, and because they're running into scaling issues just like Bitcoin would without Lightning, for example, where they can only handle so many transactions. Fees get very high on Ethereum, but unlike Bitcoin, I mean, Bitcoin, the average transaction size is pretty big, so it can withstand pretty high fees. And when you need smaller transactions, smaller fees, that's what Lightning Network's for. Whereas in Ethereum, you're doing more complex transactions. Like, for example, if you're doing different swaps and things like that, you're paying very, very high fees. And so there's a strong incentive to spill over onto cheaper chains. And then so Ethereum 2.0 is trying to scale, right? So it's trying to do more on the base layer. And so they've changed the roadmap a number of times. But basically you can have different types of nodes and different types of you're basically almost like an army of different nodes where certain things are kind of validating certain parts of the blockchain because nothing is big enough to validate the entire blockchain unless you're running a data center. And so that just it becomes a rather centralized entity. And there's really when it comes to blockchains, there's two types of centralization to worry about. One is the technical decentralization. Which is what you get, for example, if Infura goes down, you run into kind of blockchain-wide issues, for example. That's a kind of a technical centralization issue. And then two would be developer centralization, where say one foundation or one team has the capability to push through changes more easily and change monetary policy or change designs. Whereas if you have something that's more inherently decentralized, it requires true consensus to support. And so they overlap, certainly, those two types of centralization, but they are slightly different in kind of the risks involved.